Hello, everyone. Thanks for coming on today. This is our oil and gas masterclass. Even rhymes. We're super excited to do this today. And the whole kind of topic is a deep dive on oil and gas investing and really how to evaluate energy investments, right? So,
Right.
if you've been tuning into our podcast or listening to any of the content we've been putting out at Aspen Funds, you know we're very bullish on oil and gas, meaning we're very you believe that the prices have some room to run to the upside. There's a lot of extraneous factors going on that we think support investing in this asset class. And as we've been doing over the past couple of years, we've been seeing a lot more people coming out with different oil and gas opportunities, and they're not all created equal. And so we wanted to bring on our guest today, Jeff Mohajir. We're very excited to have here in person in our office here in Kansas City. And
This
Jeff,
is oil and gas investing. I thought this
oh,
was
is
a
it the
pickleball seminar.
wrong one? Well, Jeff has been in this space for almost 40 years. Right?
40 years, yeah.
Okay. So he's seen it all, been through many, many cycles, and obviously just has a whole lot of experience and wisdom to share with us. So,
So we're going to be
let's dive
focusing
in.
on
Yeah.
making oil and gas investing approachable to investors who haven't done oil and gas before. So a lot of folks in our world have done real estate investing, note investing, other kinds of investing, but oil and gas is one of these scary things that a lot of people have had bad experiences in or have heard about bad experiences. So we're going to dive in and actually look at how to do this right.
Yeah. So before we do that, Jeff, can you give a little bit of your background and just
Sure.
to give people context for, your expertise and
Sure.
track record?
I went to the University of Kansas, studied geology,
Rock Chalk.
and got a job right out of school, moved to Houston. And so a lot of people call it the Planet Houston. I did a tour in Houston where a lot of energy folks go. I worked for a company called Panhandle Eastern Pipeline that moved from Kansas City right down on Broadway to Westover in Westheimer in Houston. And it was a great experience. It was interstate pipeline. Got a lot of great experience. They moved me very quickly from the geology department into contracts. So I ended up doing a lot of contract work and was there for almost 5 years. My dad had started a consulting firm here in Kansas City with an office in Houston.
And it was energy consulting, right?
Energy consulting, petroleum engineering, geological consulting, geophysical consulting. And his anchor client was a large endowment fund that was wanting to do energy investing. And back in the late 80s, oil prices had crashed, and this fund had put together a mezzanine bank fund. And so we were named the technical or exclusive technical consultant to the fund. So the fund basically made around $400 million in investments. We advised on all of those. Obviously, by making $400 million, we probably looked at over $1 billion worth of investments.
Wow.
And
And advised on geology, engineering, all things technical related to this and valuation
technical and economic.
and economic.
Yeah. So we were running all the economic models, doing all the forecast. And, we were very fortunate in the fact that the fund made over a 20% rate of return when they closed. So at that point we decided, hey, you know what? We're doing a pretty good job for the fund. Why don't we consider doing it for ourselves? So in 1992, we came across a project that we really liked, and we decided to move forward on it. It was in the Rockies. It's about 400 producing oil and natural gas wells that we partnered with a company called KN Energy, who was, interesting enough, was the predecessor to Kinder Morgan, if anybody knows that name.
Sure.
So they're the predecessor to Kinder Morgan. They were our partner, and we went out and we developed probably around 100 to 150 wells in about a 3-year time span. KN sold their interest to a small company called Tom Brown, Inc. out of Midland at the time. This would have been 1997. A person by the name of George W. Bush was on the board of Tom Brown. And he, after they bought us out after they bought us out, he left and ran for governor of Texas. But they since had been sold to Encana, and now they have been sold to Aventive.
And how did they do on your investment?
They did great. I remember in 1997 when we sold, we priced all of our natural gas. It was a very natural gas centric play. We priced all of our natural gas at $2 per MCF. Gas price flat for the life of the property. So this is 50 years, long-lived reserves. And we sold the reserves for roughly about 50 cents per MCF, proved MCF in the ground. And that was 1997.
Wow.
I thought we did very good on it. So in 2003, Tom Brown took our assets, sold to Encana for $3 per MCF in the ground. So they did better. And that actually gave me a great lesson about capital formation and what your motivators are in terms of your divestment strategy and how capital can kind of push you maybe a little sooner rather than later in terms of selling something.
Right.
And through the past several decades, you've done, I think, 5 funds, right? And even
Actually, five different LLCs or investment opportunities is what we really have done. Yes.
and at different points of the market. I mean, the latest one you did was
Correct.
2020, right? Which
Right,
seemed like a hard time to be in the
Right.
space, but is obviously done very well.
Yeah, that we were, again, very blessed. We took advantage of a situation where 2020, everybody knows, April 11th, 2020, oil traded at negative $37 a barrel. So what ended up happening was there were a lot of private equity companies or firms that really got killed. They were looking for ways to rationalize their portfolio companies. We happened to know one of the portfolio companies, and we put together a letter of intent to buy them out. And so we put the letter of intent in place in September with a August 1st, 2020 effective date, and ended up closing on December 29th, 2020. So, it was, a lot of people at that time thought, energy's dead. Never go above $35 a barrel again. Gas will never go above $2 an MCF again. But obviously, we thought that was a great time to be investing.
Right.
Well, I think before we dive into a lot of the more technical things, I'd love to just set the stage because inevitably, whenever we talk about oil and gas, I just got an email from someone that said, I can't believe you guys are considering this. I mean, just in a couple of years, EVs are going to take over and oil and gas is going to be irrelevant, right? And so there is this kind of, sense and narrative that is being consistently propagated with, the mainstream news that oil and gas is yesterday's energy. And why would I be investing in something that's no longer be relevant, right? So I think let's dive in kind of at the big picture here of why does it even make sense to consider this space, and are we going to be around, in a couple of years having this conversation?
Well, I think, number one, it's, you said it, it's about energy and power, electricity. Obviously, I think we are moving towards an electric or a power-driven economy. But what most people don't think about is, how do you generate power?
Right.
I think I've told you this story maybe, and I have a great friend who lives down the street from me, bought one of these beautiful, electric Mustang SUVs, and he came and picked me up, and it's great. And he said, touting some of the green energy. And I told him, I said, I'm a little upset with you. And he said, well, why? And I said, well, you've just increased our carbon footprint on our block. And he said, well, I bought an electric powered car. And I said, well, you realize that the majority of power in Kansas City is generated by coal. So the more you're plugging in your garage, the more coal generation for power there is. And he said, well, that's too complicated. I can't think about that. But that is it. Oil and natural gas, particularly natural gas on the power side, the more electric cars there are, the more batteries there are, it's going to take more natural gas to generate that power.
Yeah.
We've got a few slides here. Do you want to kind of
Yeah.
chime in on some of the kind of green energy thoughts?
Yeah, and so green energy, I mean, we're all rooting for green energy, right?
Yeah.
But there's really, a reality check that's needed, according to the EIA. Um, by 2030, existing mines and projects under construction will only be able to produce about half what's needed to satisfy demand for electric vehicle production. So 59 new lithium mines are needed, 38 new cobalt mines, 72 new nickel mines. And it's worth noting that the lithium mines, for instance, it started in the last decade, took an average of 16 years to develop. So, and by the way, those mines all operate on diesel, right? Diesel
Very high carbon
excavators,
footprints, yes.
diesel trucks transporting diesel operated, refineries. And it takes a massive amount of fossil fuels to do that. Go ahead and flip the next slide. They're saying we need about 40 times the lithium production, 40x in the next, let me see, between now and 2040, 40 times more lithium. Well, where are we going to get that?
And this is just to meet kind of the stated goals for
the
electric
EIA
vehicle.
electric demand. And graphite, we need 25x, cobalt 20x, nickel 20x. And not just that, but a lot of time to develop it. Go ahead and do the next slide. So this kind of answers the question, and for anybody that can see this. So if you look at all fuels today of all energy sources right now, 83% are carbon, 83%. It's about a third, coal, natural gas, and oil. But as you pointed out, if you want to move a mass of something from one place to another, only liquid petroleum can do that, right?
That's correct.
Right now, that's ships, airplanes,
Correct.
Trains, they're all running on liquid petroleum products.
Yeah, I always think about this. I always think about, it's a little bit like physics, right? We live in a global economy. Our whole economy, Amazon, is all based on moving products freely around the globe. And the only way to efficiently move mass is through liquefied petroleum.
Yeah. So back to the slide. So 83% of fuels are carbon. So 17% is non-carbon, and that's nuclear, hydro, wind. Wind is 17% of the 17%. So it's just really not much. And we've been trying to decarbonize really since the 1970s. So 50 years and we've gotten 17%. While we're all rooting for it, the truth is, green energy just is not ready to carry the load of what we have.
And I think going back to the kind of mineral exploration needed for lithium and all these other ones, in the U.S., there hasn't been a new lithium mine permitted for how long, right? And it's just that we're not making the steps needed to actually increase the production, right? It's magically going to appear somehow.
Right. So it's a lot of wishful thinking. The truth is we are a carbon-based economy, and we will be for the foreseeable future. And there's a lot of hope out there, and fission or fusion, but it's not close. The world is walked away from nuclear, which I think is a great alternative. Even new nuclear is very safe and very cost effective and very clean. There's new generation of nuclear technologies. Fission. Fusion is a long ways away. There's nothing even close. So yeah.
Do you want to comment on kind of some of the ESG narratives that's driven supply down?
Yes. So there was we can talk more about ESG a little bit. But there was, during the end of the Obama recession, I mean, you remember the Obama recession, it's like the economy never quite got going, and energy demand globally just started to plateau. And if you look at the curves, it started to kind of plateau out. Well, the narrative came forth. We've done it. We're post fossil fuels now, right? And that was great until demand starts creeping up, which we saw, in the post-COVID era. But what happened is this narrative. Well, why would you want to invest in a dead business, right? And it has no future. And so what happened is global energy investment decreased by 55% in new production, generating new fossil fuel production. And it's one of these things that's so unpopular. If you say you're drilling for oil, you almost have to put a paper bag over your head, right? Especially, if you're on the coast or something, or in the wrong crowds,
Yes.
and you're destroying the planet. And so that just, people exited the market. And meanwhile, a lot of our politicians, John Kerry, has been going around and trying to make sure that there was no access to capital for any of the fossil fuel producers. So literally you couldn't get bank loans, you couldn't get credit, and really undermining this. And the problem with that, okay, so it's dropped by 55% investment. The problem is that global energy production is decreasing about 5 to 7% per year because of depletion, meaning you're pulling the oil out, your production is dropping. We need 5 million barrels a day of new production coming online every year just to maintain production.
Correct.
Production levels. So the problem is, if you don't invest, you don't get that. So what we're seeing is you simply can't fix it. 7 years of underinvestment is going to take 7 years of overinvestment. After 7 years, we will see production begin to increase. But the problem is there's not a lot of marginal production. So as soon as we see demand, our view is we're going to see energy prices rise. And right now, because of China's slowness and a few other things, we're not seeing demand hitting yet.
Yeah, and I think kind of playing to that thought of the demand side of it, most estimates are predicting even by 2030 that demand for oil and gas is going to be at least the same, if not increase. Just because we can't hit these goals as fast as they want us to kind of convert to the renewable energies. And it's, beyond 2030, it's probably, still pretty aggressive on how quickly we can adopt some of these technologies. So you got a decreasing supply curve, you got at least consistent, if not growing demand. And that usually only does one thing to the market.
Right.
And that's kind of what's interesting here. So I'd love to kind of, parlay that conversation into, just from your experience being in the space for a long time, what are you seeing right now as, what's kind of happening in the landscape, right? Because you mentioned earlier in 2020, when oil prices went negative for a day, and a lot of these, companies that were investing were maybe a little bit over leveraged, and got wiped out. It's kind of changed the appetite a little bit. It's kind of changed the game to where it's the thought process and how you invest is different than a few years ago.
For sure. The investment strategy has completely changed. In my career, the investment strategy for oil and gas, particularly for oil and gas entrepreneurs, had been a value play. It always been sort of a value play. I mean, we have a very capital intensive business. As Bob mentioned, you have somewhere between a 7 to 10%, just a natural reservoir decline, for most reservoirs. You've got a depleting asset that needs to be replaced with new drilling, which is capitally intensive. And so it was always a value play. You buy something, you sprinkle just the right amount of capital into it, and then you sell it to a much larger investment company or oil and gas company for a disproportionate interest rate of return. So
when you're saying value creation, is that through drilling, or is that buying existing production?
Value added through drilling, and you basically are selling the undeveloped locations, the proved undeveloped. So the upside, you're selling the upside.
Right.
Because
so you're proving out the reserves, and then you're selling that to the next guy to go drill it.
Very similar to something that you would experience in the .com era. You're basically selling upside. Well, with COVID, and because we had so many capital institutions get hit hard, and we're not able to return capital back to limited partners, we have
in the oil and gas space.
In oil and gas space, we have had our industry go from more of a value play to much more of an income play. And it's brought in a discipline where, there was so much capital, and because of interest rates, it was relatively cheap capital that was getting deployed that, when prices went down, the private equity, the institutional capital kind of dried up. And then you have, on top of that, the ESG, which you have a lot of the limited partners that might be in a private equity fund, be it an endowment or some kind of other institutional, capital source, just doesn't want to invest in hydrocarbons. So
people are exiting the market. So capital fled.
Capital has fled. It's brought some of a discipline to where, not only do you have that, but then you also have sort of geologically, you've got where we have all of these plays have sort of been figured out. You don't have a land rush, so to speak. So, all of the plays in Texas, Oklahoma,
meaning the producing basins,
correct,
they're kind of known quantities.
Correct.
Yeah.
Correct.
Yeah.
Correct.
So it's not this wildcat.
Right. Everybody's chasing, trying to get into a new play and, trying to, figure out how we can get, high returns on our capital being deployed.
And so as capital has fled, a lot of the big boys have stopped leveraging heavily, right? Capital is there's got much more conservative. They're not putting debt on these things. There's not a lot of, capital is far less available today, both in terms of debt and equity, to big boys and little guys in the space. And it's also caused the pricing of oil fields to drop dramatically. When you say it's gone from, it's not priced on income, it's not priced like a .com where, hey, we got this great idea, it's worth $1 billion.
Correct.
To now, how much money can you produce cash for me next month? That's what I'm going to pay you on. So prices of these producing assets have dropped precipitously.
Correct. And investors
are on sale, right?
Yeah. The investors are much more concerned with dividends or distributions.
Right. Instead of blue sky.
Correct.
Hey, it's going to be amazing.
There's also been kind of a broader just approach to not oversupplying the market too, because part of what happened in kind of COVID era, obviously demand, but then there was a lot of just pump. And you've kind of said that not just discipline on the capital structure side of, having lower leverage, but also a sense of, hey, let's not flood the market because we kind of like these prices a little bit where they're at, right? We don't want to get back to $20, $30 oil.
Correct. And, there's this old adage, right? The best cure for high prices are high prices.
Right.
The best cure for low prices are low prices.
Right.
And so you have this idea that capital kind of is efficient and it comes into a market when it's needed. At the same time, we have oil and gas companies who, got really kicked, during COVID. Prices have come back up in 2021, 2022. And so a lot of them figured out their bank loans and their balance sheets are in good shape.
Right.
And so now they're saying to themselves, look, for us, it's better to maintain, instead of having 12 rigs running and trying to bring a bunch of supply on, it might be better for us to only have 4 or 5 rigs running.
Right. No one's chasing the upside as much anymore. And you're seeing this when prices hit $120 a barrel, not too long back, you didn't see a lot of new production coming online. People are like,
Not only did you not see a lot of new production, you didn't see a lot of new capital because these investment allocators, whether it be at a pension or at a, endowment or a private equity, they don't want to be the one to have to write down their investment 30% again, like they did in 2020.
Right. And this was kind of, you're talking about the COVID crash. There was a crash before this, was around the 2016 timeframe, right? So much of the industry, there's bankruptcies left and right. And it was people chasing the kind of the fracking revolution, which really, and the whole horizontal and fracking technology. People don't realize how new that is.
Relatively new, yes.
And so all these plays, these basins got massively developed. And it was a lot of blue sky, a lot of .com type big emotion or exuberance, right? And then when the crash came around 2016, just bankruptcies galore in the industry. So it's it's kind of the second major hand slap on the industry. And now the industry is just like, we're not taking any risk here.
Right. Right. I think it has brought in a discipline. And so you've seen that from, it was an overdevelopment in some of these plays to now just the right amount of development. And a lot of companies
or underdevelopment.
A lot of companies at the time in 2016 were trying to drill their way out of a bad situation.
So prices are collapsing. You're
Correct.
drilling faster and faster
Correct.
to earn less and less.
Correct.
And, and then it's the
It
bottom
was sort of
fell
the perfect storm at that time.
Yeah, it was. And so a lot of discipline is coming in, but what's happened because of this, because capital has fled and because of ESG, I mean, ESG people don't realize there's a lot of activist investors that have taken over boards of the majors, and they're focusing on renewables instead of oil and gas development, which is great for renewables, but it's not very good for oil and gas, and creating a big undersupply.
And
the other thing that's important is you're right about the majors, but really when you think about oil and gas development and production in our country, it's what we call the independent oil and gas companies that really are the ones that go out and take risk in new areas or do a lot of the drilling, do a lot of the geology. And those companies, they're not Exxon, they're not Chevron. They have to get access to capital, whether it be through institutions, private equity, or banks. And that is very hard for them. So they're not driving development.
Right. Okay. So
let's shift kind of the technical here. So we've, a lot of the people on this webinar are probably thinking, I've seen some things come around. I've heard of, vertical versus horizontal. I've heard of fracking. I've heard all these different terms, but let's just kind of break down. If you kind of mentioned earlier on the oil and gas geology and just kind of how
start with geology. How does oil and gas work? So, and think about a real estate investor. We don't know much about this kind of thing. So, give us your entire degree in 5 minutes or less.
Well, when I think about geology, and it always does sort of start with the rock, because you're producing oil or natural gas out of rock sediments. And rock is obviously subsurface. So that's one of the things to always kind of think about. We think about real estate investing, we think about something on the surface. One of the hard pieces of oil and gas is, as opposed to like coal, you mine coal or you mine minerals, and you can put the minerals up on the surface in the warehouse next door. Well, with oil and natural gas, it's typically, you're not storing it. I mean, the storage is in the ground, and now you're trying to figure out just how much is down there. Will it produce economically at given commodity prices, at given expenses? And so it can be anywhere from 3,000-4,000 feet. Actually, surprisingly enough, the natural gas industry, particularly for natural gas interstate pipelines, started not too far away from this spot out in Lewisburg, Kansas, where they were producing natural gas out of coal mines. Pretty shallow, 1,000 feet, 1,500 feet, and they were collecting this natural gas and then selling it to end users, and that's really kind of how the mid-continent interstate pipeline business started. So it goes down, somewhere anywhere between 1,000 feet all the way down to 30,000 feet, and then obviously
so
the offshore
6
stuff.
miles.
Yeah. And it can get it's the way that our industry drills is engineering feat on how they can bring oil and natural gas to the surface. And then we've had this major new technology come through for horizontal drilling.
Okay, but before we get to that, so I think a lot of people think about an oil and gas or an oil well. You drill a hole and there's this giant lake of oil down there, and you hit it, and then it gushers up, and you sell it. It's not really like that, right?
No, it's a pond. It's not really like, the best analogy I can give you is that, you've got a cup here and you put a straw in it, and each reservoir, each straw has a different size cup. and the way that you suck the oil or natural gas out, the pressure that you're using, that's kind of what we're trying to figure out is just how much is there.
But it's not a reservoir in the true sense of the most people would think about it. It's really just oily rock.
It's oil. Well, yeah, it's not the clampets where you go out shooting and oil comes popping out of the ground. That's typically not how it works.
And so I think a lot of the traditional wells that were drilled early on in the 50s and 60s and stuff, they were certain geological formations. There were salt caps and other things that really very unique things are very rare, very difficult to find, and that had a lot of oil. A lot of that stuff's played out. And what's happening now, and you correct me if I'm wrong, but my understanding is it's in shale plays. So these are very tight plays. So the rock is very tight. It's not very porous. So the way you get oil out is the rock has to be porous, right? It has to, think of a sandstone or a sand where the oil can move through the rock.
That's permeability. Yes, that's permeability.
Permeability. And if the rock's tight, it can't move. And it's also laid out, in these, for example, the shale plays, it's laid out in sedimentary layers. So it's this giant layer, like you go out to the Grand Canyon, you see layers of red and then layers of white, and it's layers of oil-bearing rock that are horizontal and for hundreds of square miles. Yeah. And then there's another layer below that that's a different kind of oil-bearing rock that's hundreds of square miles, and maybe it's 10 feet deep or 20 feet deep in other places, but it's very predictable, right, where it is.
Correct. And that's where the new technology came into play for horizontal drilling. So what happened was, vertical drilling, obviously a lot of wells have been drilled.
So vertical drilling, you just drill straight down and whatever happens, happens.
You've got a target, you go down, you're drilling vertically into it. You have a target reservoir. And what happened was and when you're drilling, they have geologists on site and they get these, what they call shows as they're drilling. They'd be oil or natural gas. And a lot of them, as these guys were drilling through shales, they would get these great shows, but they could never get them produced.
Right.
And so people would scratch their head. Gosh, I'm drilling through here and I get these great shows. I can't get this thing to produce. I'm always producing below it or I'm producing above it until, and I don't know his name, but from what I understand, it was a young completion engineer at in the Barnett Shale that worked for Mitchell Oil and Gas that broke the code on how to drill horizontally into a shale. And you can imagine, you're drilling and then you're turning the pipe 90 degrees into this zone, and then you're trying to figure out a way, and you have to keep it straight, because if you undulate, you're going to create P-traps to where you can't really produce past it, right? It's like your kitchen sink.
Sure.
You can't get the gas or the oil past it. So then you have to find a way to complete it to where you can actually coax the oil or the natural gas out of that reservoir.
So literally vertical, we've drilled some vertical wells, and it costs, for a mile down or so, $250,000 to drill, and then another $500,000-ish to complete it. Meaning completing it means putting the pumping stuff on top and the piping and all that stuff. Casing, yeah. So now horizontal is a completely different animal. So it's maybe, $5 to $10 million per drill, right? And so these things can go miles and miles and miles. So they'll maybe go a mile down, and then they'll go
sometimes 3 miles out
horizontally.
Yes.
And you can drill this way horizontally, then you can go drill this way horizontally, and then this way. So you can kind of hit all the points of the compass from one single location, right?
Yeah, which is great. What's great about that is, we think about, we had, we had vertical wells. We might have, on one section, 640 acres, we might have something like 10 or 15 vertical wells on that section. Now, with horizontal drilling, we have one well.
One well
can drain the same amount, and you can imagine there's less issues with operations, and there's probably less capital.
Okay. And talk about the drilling risk, because I mean, I'm a geologist enough to know that this stuff is in layers. And if the layers are predictable in their oil-bearing nature and their nature, that really there's not a lot of ways to miss in a horizontal well.
There's not a lot of ways. And, I think there's always, we talk about drilling, we talk about dry holes. And, a geologist will come up, he'll draw some lines on a map and say, this is, where I think the reservoir is 5,000 feet below the surface. And you drill down there and you say, wow, we're getting some shows. There looks like there's oil or natural gas down there. And now I've got to complete it. And this is where the engineering comes into play. And quite frankly, in any oil and gas investment, I know we might talk about risk in a little bit, but this is mechanical risk in being able to complete the well in the right fashion to be able to get the oil and gas to come out. So while you might have geologically a well that hit, if you don't complete it right, you might have it might be a geologic well. It might not be an economic well.
Back to the risk. So if you do complete it well, the horizontal wells have a very high success rate, right? Of hitting economic.
Now they do.
Yes.
Because in so many of these plays, going from 2008
the geology is
through
so
2016, so much of the risk has been taken out. For an example, in one of the areas in Oklahoma, you might have when you put together a drilling unit, you might consider putting what we call a parent well will be drilled, and then they'll drill it horizontally, complete it, and oh man, that looks good. A geologist or an engineer might come in and say, I can put 11 more of those out here. And he drills 11 more, and you can imagine it, $10 or $15 million a well. That's a lot of capital. Well, he starts to find out on the 6th or 7th well, it's starting to interfere. I'm stealing production from my parent. So these children wells are taking production from the parent well. And so what we found out over time is that, okay, while you might drill a parent well, you've confirmed what you thought geologically and engineering wise. Instead of having 12 children, you might only need 5 or 6 children. And that is just a good way of preserving capital.
So bottom line is a lot of the risk has just been taken out of this. Now,
correct.
Now talk about fracking. So fracking is another of these things that is just, this energizes so many people, but I think very few people understand it. So do talk about fracking.
Yes. Fracking's been around since probably the 30s or 40s, quite frankly. And
I didn't know that.
Yeah. We've been fracking wells in this country and around the world for a long time.
So
and again, it's basically after you drill, you talk about permeability. And sometimes you have natural permeability in a reservoir to where the oil and natural gas will just come freely. As you're drilling, you put steel casing down the hole, right? And then you have to perforate with, little bullet holes. You basically send a little gun down there. It perforates the steel casing. You're shooting bullet holes in the steel casing. And that's going to allow the reservoir, the oil and gas in the reservoir to seep into the steel casing, and then you're producing it up to the surface. Sometimes, depending on the reservoir pressure, the reservoir will do it on its own. Other times, as I mentioned before, you have to coax it out. And one of the ways we coax it out is by fracking. And the way that you frack is after you've perforated, you'll go in at high pressure, sometimes temperature, and you will take water and some sand, and you will push it out in those perforations to kind of create, quote, fractures.
So you pressurize the rock,
correct,
to get it to crack,
and you have sand, and you have water, and it's not.
So the sand goes into the cracks to kind of keep them open,
to keep the fractures or the fissures open, so that the oil and gas can
And so
produce.
it increases permeability and allows, and this is really what unlocked a lot of the shales that were
Correct.
very, very tight. They didn't have high porosity and you couldn't produce much.
Correct.
So with new fracking techniques, we're able to produce it. Okay, so what's the bad rap against fracking? Is it really destroying our
Well, the bad rap is that
aquifers?
the bad rap is that the what they're mixing in with the sand and the water is some kind of chemical that is detrimental, and you get a lot of these oil and gas groups that will go out and say, oh well, that it gets into the aquifer, and typically, most oil and gas companies spend a lot of time trying to protect aquifers. They put a lot of casing in place. They make sure that, when they frack, there's typically a rock that will help from having the fracture go up into the aquifer. And a lot of times it's, as you mentioned, a mile or 2 miles below the aquifer.
Right. So people don't realize the aquifers are not deep.
No, they're like 300 feet or
The aquifers,
500
yeah,
feet.
they're really on the surface.
Correct.
And where most of the drilling is going on is far, far below, maybe
Right.
even a mile below.
Right. So we spend a lot of time
And
trying
the
to
truth
protect
is,
that.
the oil and gas and the water are already in the same vertical space there anyhow, right?
That's right.
So
And there's
So-
always natural
So
fractures.
there's some bad actors doing fracking, but it can be done responsibly.
It's done responsibly, and typically it's I've seen people go out and drink frack fluid, and they're fine. I mean, it's just not an issue. But like you said, there's always some bad actors that don't do it the right way. But for the most part, and we've been doing it for a long time, and there's always some accidents that happen, but you don't hear about it very often.
Yeah.
Right.
One of the things I wanted to kind of talk about too is just the different ways to invest in oil and gas, right? Because not every deal, not every, drill type is the same, right? And so there's lots of different ways and types of ways to invest in oil and gas. So first, can you talk about what is the difference between, mineral interests or royalty interests and working interests, right? Those are probably the two big categories of ways to invest.
So a mineral interest, in basically, if you think about it from a real estate perspective, and again, sort of on a surface perspective, you have ownership of surface real estate, but then there's also mineral ownership. And typically, somebody owns the minerals. Sometimes it's the same person that owns the surface, owns the minerals. Sometimes they're bifurcated, or a split estate is what they really call it. Like out in Colorado or Wyoming, you might have a rancher that owns the surface, but the Department of Interior or the BLM really owns, the federal government really own the minerals. So in that case, you got to go out for us that are looking to try to develop oil and gas. We typically go out and try to take a lease from the mineral owners to be able to lease that space, however many net acres that they own, so that we then can drill. And you typically need, depending on what the reservoir size is and what your economics are, you typically need X, let's just call it 100 net acres to be able to drill a well.
Okay, so just like I think about somebody who is a land investor here in the city and may go out where they think the city might be expanding, and you go buy a bunch of farmland, and you're hoping some point the city will grow into that, and the value of that land will go up, and you will make a lot of money doing that. And that's very similar. So people can do the same by buying mineral rights of land and hoping that someone ends up wanting to produce it. But it's kind of passive, right? It's very passive, and it's a kind of a waiting game, right?
Correct.
But I know a lot of people that are offering those kind of investments. What would you, if you're going to buy a royalty interest investment, what should you be looking for?
Well, you should be looking at development. Obviously, your mineral ownership or your royalty ownership in a oil and gas well is really only valuable if the product gets
Something's being
produced.
produced, right?
Yeah, so you really need to get produced. So the couple of things that I'd be looking for is, number one, who's some of the active operators, who are some of the folks that are drilling in the area where you've got the mineral ownership. The other thing I would be looking for, particularly if it was natural gas and even oil for that matter, is what kind of infrastructure is in place to be able to get your natural gas or your oil to the marketplace. Because that's one of the things that sometimes,
big area.
And you only can get paid if you can get your product sold.
Okay. Now you have not done a lot of mineral rights investing in your 40 years, right? So
No.
why not?
Because we've always sort of taken leases. We've always looked at it as we much prefer looking at owning a working interest in a well,
right?
As opposed to a royalty. Now we do, full disclosure here, we have we have a royalty interest in about 750 wells in Southeast Kansas.
Okay. So you do like royalty interests.
That we've had for a long time. And they've done a good job, and we've got a good operator down there that produces and operates the wells. But we haven't been active in trying to pick up or trying to buy mineral interest.
Yeah. It's generally more of a passive kind of.
It's much more passive and
a waiting game.
And it's very land intensive because you've got to go, and it's more, in my idea, my way of thinking, it's a little bit more speculative because you're waiting.
Right.
You're waiting for the game to come to you,
right?
As opposed to you going out and playing in the game.
There you go.
Yeah.
Okay. So typically you as a royalty interest, so someone who would come and then lease this from you, and the idea is they would agree to pay you a royalty for producing your land, the minerals in your land. You get a royalty for that, and that lease is generally, and so this is an operator is going to lease that up. And then those leases are traded as well, right?
The leases are traded. Typically what they do is they come in and they'll give you a 3-year or a 5-year lease, and they'll say, hey, I'm going to pay you a lease bonus. I'm going to pay you, as an example, a few years ago, there was a hot play down in Texas where mineral owners were getting, $100 an acre, a mineral acre for their acres. A couple of operators came in a mile away, proved up the resource. All of a sudden, they're selling for $10,000 a net acre. So
for a lease,
a lease, yeah.
So the leases are traded actively, and this is where you buy leases. This is what you like to do primarily.
Right.
Is you'll buy leases.
Correct.
And those leases typically have to be held by production, right? So
yeah, so you pay. So you'll pay for a lease bonus, and then you typically have 3 years to 5 years to drill on that lease. And as long as you're producing and paying the royalty owner who you've leased the minerals from, and this is kind of a contractual term, but contract quantities or economic quantities of revenue, then that lease typically stays in effect.
And if you stop producing, then that lease is in question or it's lost.
Correct.
So one of the things you have to do, and this goes back to the land piece of this, is if you're looking at, well, what are the rights? Do you have a valid lease? You got to look at the ownership, and you got to look at production. You got historical production and see, have they met the terms of the lease?
Not only, you have to look at production, make sure that the lease is in good shape, but you also have to do, just to make sure, the title is in good shape. And, and you have to go to the county. A lot of times we have land people that go to the county courthouses to make sure that the people that own they own it.
There's this phrase called land people in the real estate. It's called title companies, right? Who go and make sure the title is square, and they also check production and make sure that the lease is valid. So
correct.
It's a lot of work. I mean, for a certain piece of dirt, there's quite a bit that has to go into this to make sure that you actually have a real asset there, right?
That's true.
Okay, so talk about operating, non-operating. We talk about that. So we've talked about, working interests and mineral interests, and, kind of more the working interests are more active, more play the game. The mineral interests are more passive. Passive. You wait for the game to come to you.
Yeah, I think
talk about operating and non-operating.
Yeah, on the working interest side, I think one of the things to think about it is working interest pays for expenses. Mineral interest or royalty interest don't.
Gotcha.
So whether it be development cost and our monthly operating expenses, working interest pays expenses, mineral interest don't. So the difference between a non-operated working interest and an operated working interest is that just as it sounds. You've got the operator who is Devon, Exxon, Chevron, Continental. They're operating their working interest, whatever they typically have. I mean, not always, but typically have the majority working interest in the well. And that would be called an operated working interest. You also have people that kind of come in that have taken a lease with some of the mineral owners who then have the opportunity to participate in a well that gets drilled on a working interest basis, but as a non-operated working interest.
Gotcha.
And so they own they have actually an undivided ownership in the well, but they're just not the operator.
Okay, so just to give an example, so you buy a lease from a royalty guy, and you agree to pay him a certain royalty percentage, and then you'll partner with, let's just say, a Devon, who's a big major producer, right? And they'll take an 80% operating working interest, or they'll basically buy your lease from you, or they'll operate your lease for you, and you get 20% of the revenues, and they get 80% of the revenues. Is that right?
Correct.
And you share the costs, 80-20, is that right?
Yeah.
And you share the revenues, 80-20.
Correct.
So you're kind of riding along their coattails and letting them, they're kind of taking the lead. They're doing the producing, they're determining the revenues and the expenses, but you're getting a cut of it.
You're getting a cut of it. You're bringing something to the table a lot of times, because if you're in a large area with them, they're doing some capital allocation. They're doing some risk mitigation. So they don't want to take 100% of a well. Not many owners or operators really want to own 100% of the well.
Explain that.
Because you're taking a lot of risk. I mean, it just depends. You're like, like anything else, you'd like your dollars to go farther,
Yeah.
right? So, and sometimes because sometimes your working interest owners, we're an example, might have a highly technical group. As they're thinking about drilling, they would be running ideas by us in terms of drilling.
So they actually like partnering with you in a lot of cases.
We've had a lot of good,
because you guys are a very good engineering firm, engineering and geology, and they like to bounce it off you. And you maybe bring ideas to them, right? And say, hey,
Exactly.
We're looking at this spot right here. We think this is where the pay is.
Exactly.
One of the cool things with this, with the mineral interest, a lot of times you're having to, buy land in hopes of new production coming down the road. But a lot of times you can go and buy existing production that's producing current cash flow. And then you kind of alluded to it, but you have the right to participate in new drilling, but you don't have the requirement to do so.
That's
right?
right.
So break that down a little bit, because that kind of gives you a lot of flexibility in
It's
what you
incredible.
want to be able to do. Yeah.
Right. So you and we've done this. I mean, as an example, I think I told you we did a deal in Colorado and Wyoming. We bought into 400 producing property. We took a non-operated working interest in 400 wells. The operator and we owned about 100,000 net acres together. We put together a joint development agreement with the operator. We liked the way they operated. They liked the way that we identified new assets or new targets to be able to drill. And together we drilled about 100 to 120 wells. And
you chose whether you wanted to participate in those or
we
not.
chose whether or not we weren't obligated to. So that's the optionality piece that we really like.
They say, we're going to produce well A, and they're saying, hey, do you want to take your 20%? And you say, nah, I'm going to pass on that one.
On the flip side, we might really like an area that they say, we don't really want to, but we think, boy, it makes a lot of sense to develop this, particularly because of commodity prices. You can propose a well. So it goes both ways. You can propose a well, and then they have to make a decision on whether to come in.
And if they pass, you can go find another operator.
You can find another operator or find another partner. That's for sure.
Yeah, I love it.
So talk about just the types of drilling, because I think, the common thought is the wildcatting, where you're going, you're
Right.
just exploring new areas,
I'm going to go drill it.
Let me just pick this spot and see if there's oil there, right? Versus, infill is
divining rod out there.
That's right. Yeah.
And so a lot of these things, when you're going into an existing basin, in a non-op working interest, you're already buying production. There's already a good amount of development in the acreage. And a lot of times you're participating in more infill drilling, which, is more just kind of filling out those children wells, right?
Correct. Right now there aren't a lot, like I mentioned before. 10 years ago, there were 3 or 4 different plays where there was a lot of exploration going on, where there just hadn't been very much development, and companies were coming in with a geologic idea and drilling what we call wildcats or exploratory wells. And there's a place for that. That's obviously high risk, high reward type stuff. But for us, we like to stay in areas where geology's already been proved out.
The minerals are well defined. The basins are well defined.
And
people know what their characteristics, they know where they are.
Correct.
Yeah.
And so you come in and you're taking that geologic risk off the table.
Right.
There might still be some mechanical risk. There might still be some commodity price risk for sure.
Right.
But you're taking the geologic risk off the table. And as Ben said, the SEC or the SPE, Society of Petroleum Engineers, comes up with some terms that try and give investors a sense of how to understand risk. And when you're talking about reserves, they put the term proved in front of, so it's proved, developed, producing. That's wells that are already producing. There's proved behind pipe. That's reservoirs that have not been completed, but are in a well bore that is producing in economic quantities. There's proved, developed, non-producing, a well that has been drilled, looks like the reservoir has been established, but it's not producing yet. And then there's proved undeveloped. And that basically means, it's kind of, the way to think about it is geography. Mm-hmm. It's a proved undeveloped location.
Meaning, there's for sure oil down there. Exactly, how much, pretty accurately how much oil is down there.
And there's an offset well that has demonstrated it can produce commercially.
Right. So if you're drilling into proved undeveloped, you don't have a geology risk, basically. It's there.
Minimal.
Mother Nature will put faults and folds and all kinds of things in place. But yes,
completion percentages are pretty high, right? Above 80% is
the
probably,
SEC wants an investor, when proved undeveloped reserves are reported, to have a sense that these are less risky than wildcatting.
Right.
Gotcha. Sure. And I think it's just an important thing to note, because as people are probably seeing more deals and opportunities come across their emails, to really dissect what are you really investing in. There's a lot of folks out there that are selling kind of drill co opportunities.
Correct.
And these are, you're going in and it may be infill, it may not be infill drilling, but you're just going and drilling, and you can have 100% return. You can also have a 0% return.
So
right?
So a lot of people are selling this. I don't know why this is super popular, but literally one drill, like you're going to cooperate in one drill hole.
Yeah.
And I'm a little sensitive to this, because this is where, oil and gas investing can get a bad name, particularly for some people that don't understand. You might have an operator who might only have a 5% working interest in a well, but he's now trying to sell 95% because of the geologic risk. So he's trying to get some other folks to come in to prove up de-risk it, and then he gets to keep 100% of the offsets. So those are the kind of games that get played, and that's where our industry can get a bad name. So I just caution people to be careful about that.
And what are some yellow flags to you if you saw something like that? Like, what, for someone that's not sophisticated, how do you dissect
if an operator,
or what are the questions to ask, I guess?
If an operator didn't have a majority of the working interest in a well, that's one. What's my ownership? If the well is successful, what's my ownership in well 2, 3, 4?
Yep.
If that's,
So meaning they could sell you one well and you get all the capital for that, and they go off and, run with this 2, 3, 4, and you don't get any of that.
Correct.
They go turn that one off now that's proven it and go drill a new one that they get 100% of.
Yes.
Yeah. Very interesting. Well, let's kind of shift a little bit. We kind of been talking about a lot of these, but just the risk factors, right? So talk about, the big picture environment, talk about some of the technical terminology and technology. But now as investors, this obviously we're here because we think there's opportunity here. But for investors that are kind of new to this space, what are some of the key things that they need to be thinking about? We've put a little list here together that we talked about beforehand. And so we want to start with the geology. We kind of hit that a little bit.
But talk about it always starts with rock. You
Yeah.
got to have rock that has the ability to produce hydrocarbons. So that's number one. So you got to have the geology, and it all sort of starts with geology.
And from a passive investor standpoint, who's not a trained geologist like you, hasn't been in the space for 40 years, and they see a deal, what questions do they ask to ascertain, like, this is good geology versus bad geology, right? Like, it's kind of...
Well, part of it is, what's producing around it.
Yeah.
So what's been producing around it? Is it how much reserves have been, what have been the qualities? The qualities and the quantities of oil or natural gas that's produced out of the reservoir.
And track record of the operator of,
Correct.
success of the past wells that they've drilled. And
And, all the financial stuff. Did they bring, they have a budget for drilling? Did they meet their budget? Or were they over? Were they under? All those sort of things. So the geology, it always starts with the geology. It starts with the rock. I think the biggie, obviously, that's hard to control, Mother Nature. You can understand it. You can understand where she has, the oil and gas. The other thing it's hard to control is commodity prices. Obviously, you can do some control of that, some mitigating with hedging. And we always try to do some hedging when we get into our projects, because it just creates a baseline of cash flow. So commodity prices are always a big risk.
Just they're all over the map, and we really never
particularly now with all the volatility going on, with you've got all kinds of things going on globally that are coming at us. You mentioned it earlier. The other big one I would talk about is regulatory, which / ESG. Just what's happening, in some areas of the country. Big swaths of mineral acres are being taken off the table. I mean, can you imagine? In Oklahoma, it might take us a month to get a drilling permit. When we were in Colorado, it might take us 3 years
to get a drilling permit.
to get a drilling permit. Wow. So regulatory issues are a big factor. ESG issues are a big factor. And so we tend to gravitate towards areas that you can work with very easily with the state and local authorities.
And you alluded to this one earlier, but what's the infrastructure like, right? What's the transportation? Because you can pull it out of the ground,
Correct.
but how do you sell it to, the pipelines or the end user? And what's the capacity, right?
Correct.
Especially for natural gas and NGLs.
Correct. Yeah. So there's areas right now that are, probably the best play in North America is the Permian Basin. It's got some of the best economics, but they just don't have much natural gas infrastructure. And with the oil production comes natural gas production. And in a lot of cases, they're flaring.
Describe what that is. Yeah.
So they're venting
And
the
lighting
natural
a match.
gas, lighting a match and put it in a...
And you see these big towering flames
Correct.
just in the middle of the fields.
Correct. Yes.
So they're taking money and lighting on fire because they
Correct.
can't, they literally can't take
do
it out
anything
of,
with it.
yeah.
And because
sell
they
it.
just don't have enough infrastructure.
Yeah, and let's talk about petroleum versus natural gas a little bit. So, petroleum is a very high density, and so it's easily transported by trucks and other things, and it's economic to do so. The problem with natural gas is it's loose, right? It's
Well, it's a
very
gas,
light, and it's difficult to transport.
and it's hard to store.
Hard to store.
You have to have natural gas storage fields, which are basically depleted natural gas fields to store it in.
And so most of the natural gas that's produced, there is actually a pipe going from the wellhead to the midstream producers who are basically taking this gas and packaging it up and selling it. And so if there's not a pipe, then you can't do anything with natural gas except vent it and light a match.
For flare it. That's right.
And who wants to do that? So natural gas ends up being highly localized,
It
right?
does.
America is producing a ton of natural gas. But a lot of it, unless there is infrastructure pipes, it can't be used. And this is why you're seeing natural gas prices in Europe. What are they? What is natural gas prices in Europe right now?
There's, if natural gas was trading when I left the office at about $2.33
In the United States.
in the United States, in Europe, I think it was about $7 or $8 per MCF.
Right.
And
So 3 times the price.
3 times the price. And I think you're starting to see a little bit. Boy, I tell you, we started a business in 2005. I got to tell you the story. We started a business in 2005, and it was basically, Alan Greenspan came out and said, testimony to Congress, that the United States has 10 years of natural gas supply left. And so you saw all of these liquefied natural gas platforms that were being built to bring liquefied natural gas into our country
States.
from Saudi Arabia or from Russia or from some of these. And again, with some of the things we've been talking about with the shale revolution, technology, the access to technology, the access to capital. We have this horizontal drilling, we've got this completion technology that within 2 years, we have 100-year supply of natural gas.
Yeah.
And so now we're talking about
exporting.
Now we're talking about all these
So-
LNG to export. That's right.
And talking about LNG, so what LNG is, so these guys, you'll take in natural gas from all these little pipes coming in from all these producers, and they compress it, and they cool it, and compress it and cool it, and compress it and cool it until it turns to a liquid.
It becomes
So
liquid.
it's like taking air and turning our air into a liquid. So it's very, very cold.
Correct.
Okay. And then they put it on special ships that keep it cold, and then they move it somewhere else, and then they gasify it at the location. So very expensive, very difficult to do, which is why natural gas, again, it is inherently a local commodity at the end of the day.
It's a local commodity, but I think you'll start seeing more and more markets, particularly what's happening over in Europe, open up to North American liquefied natural gas.
Yeah. But how much liquefied natural gas is actually, as a percentage of the natural gas market, how much is liquefied?
Not very much.
Yeah.
No,
It's a
not very much.
teeny
Yeah.
tiny, it's just a
And the number of
gnat on the-
refineries, I mean, we have a limited number to refine it, and to build one and to, create a whole more capacity
You mean LNG production facilities?
Yeah.
Yes.
Yeah.
That's not refining.
That's a 10-year.
Yeah.
That's a 10-year.
Yeah. To build an LNG
Lead time,
plant.
yeah.
And even the gasification plants are not easy. So all this stuff, the infrastructure just isn't quite there. All right. So we wanted to hit that a little bit.
Yeah, I think we hit most of those. I think while we're on, we had a great question here from one of the viewers here, just talking about pricing. Price has been very volatile over the past, several years, ranging from $35 to $120. We're kind of in the midpoint right now, and not that we want to put on our prediction hats here, but talk about what are you seeing from the price environment? We talked a little bit at the very beginning of some of the supply demand things going on, but do you see the possibility, there's more upside here in price, and then also just maybe discipline in as you're underwriting deals and evaluating opportunities, it has to make sense in the current environment and in a worst case scenario, right? So talk a little bit about just pricing and how that impacts what types of deals make sense.
So yeah, there's a tremendous amount of, and we're talking about oil.
Oil specifically.
So yeah, oil being a global commodity, which we've talked about. Right now when we underwrite a deal, we think about current prices, and everything's got to make sense at a current price strip. Do I think there's upside? Yes. I think the big upside is going to be driven by demand in China.
Yep.
I think you've seen, it's always sort of this supply demand thing. I think there are some countries, big OPEC countries, Saudi Arabia, who try to control prices with cutting. You saw that they were going to cut their production by 1,000 barrels a day, 1,000,000 barrels a day. And it was a yawn because the market's already got baked in that there's going to be companies or countries like Venezuela and Iran that can make that up very easily. So right now, our world oil production is around 99.7 million barrels a day, and our consumption is around, I think it's 96.6 million barrels a day. And so that little gap is what's keeping this volatility in check. If we see anything move on the consumption side with China, with India, with South America, I think you'll see prices go up.
Right.
I think let's talk about the due diligence. So, everyone knows someone who lost money in oil and gas investment. So, give us a couple of what are the mistakes investors have made, and some of the egregious mistakes, or some of the things that operators have done poorly or wrong or dishonestly, that some of the biggest ways that people are getting creamed that you've seen.
Well, I mean, it's hard to, from a nefarious, there's just some nefarious people out there that, I would be leery of somebody that says that they've never drilled a dry hole because that typically doesn't happen. But the main thing that I would say is that folks that don't show a real sort of bent towards the technical, that don't give you a technical or an economic reason, a technical and an economic reason to make an investment. If it's just because, prices are going to keep going up to, $120 a barrel, that's probably, that's probably not a good reason to make an investment. So those are the technical piece, the economic piece, to me, are where some people sometimes the lack of due diligence in really looking at the geology, looking at the engineering, looking at the infrastructure, looking at what happens at different price sensitivities. And that's where people can get burned.
Yeah. And I mean, depleted wells, and there's something people can buy this and start hawking. I mean, there's a lot of dishonest people in this space too.
There is. I mean, when we first started our first business back in 1992, we went and we talked to some folks about in Topeka about starting a business, and what are some of the pitfalls. And they told us a story about a guy named Johnny Rocket, who was in Kansas and who was selling oil and gas leases to, investors. And he would bring all his investors out to the land, and he would turn his well on, and then all of a sudden you could hear the natural gas coming on, and he would light it, and it would be flaring, this big flare of flame. And so everybody's, great, this is great. So they get money, and then all of a sudden they find out that Johnny Rocket had tapped into a local pipeline where gas was coming out. There was just even no well there. And that's one of the things that, anyway, so those are so
there's plenty of shysters. And
Correct.
I mean, we just
saw a big Ponzi scheme that was just shut down by the
carbon
SEC.
capture, and they'd raised how many?
$250 million.
$250 million from investors to do carbon capture, having this technology. Supposedly they go onto these things and do carbon capture, and it's all a big fraud. It was nothing substantial about it. So there's plenty of fraud out there, which means the best way is just get honest people, get good operators.
And if it sounds too good to be true, it probably is, right? And so, I mean, there's, one opportunity I heard about is they create a whole new technology. It's, going to go into these Marcellus shale plays that you can't go into right now and extract, 100x returns basically. And, it's all proprietary. They can't tell you the whole method because they got patents pending. It's like, those are the kind of things, right?
Anybody's got a lot of secrets, stay away from. We met a guy who claimed to be able to find, a gram of gold in every play sand out there.
Oh yeah.
And he was convinced. I mean,
the FBI was after him. He was always looking over his shoulder. They got this technology.
Those are frustrating deals. Yeah.
Well, let's shift to some of the fun stuff. Kind of the last section here we want to talk about is, tax benefits, which, shouldn't drive the decision to invest in a deal, but there are some pretty attractive ones that as investors you can participate. in some of these tax benefits, which are mostly depletion and intangible drilling costs. And can you talk a little bit about just what that is? And I guess mostly the IDCs.
Yeah. When you drill a well, obviously you're drilling a well, and there are tangible and intangible costs. Typically, the tangible costs are equipment or pipe that goes into the ground. Some of the intangible costs are the actual completion work, the fracking, the bringing the well on, the services that it takes, the geologists on site, and some of those are all intangible. So right now you can, as part of the IRS tax code, you can deduct, those costs if you're participating. There's also you mentioned, Ben, depletion, and there is and I think it's by play, and it might be by state, for every molecule, oil or natural gas unit that you produce, you can deplete. You can have a depletion by unit based on how much production is net to your ownership. So those are a couple strategies that I know give people comfort for taking the risk. Of participating in drilling or producing oil and natural gas.
Awesome. I think kind of.
Why don't you explain that a little more? How it works from an investor's point?
Yeah, from an investor standpoint, I mean, there's different ways to invest in these deals, whether it's, as an LP or as a GP, and you can potentially take these losses against, most of the time it's against passive income, but sometimes you can take it against active income.
So, meaning you're a doctor and you have a high W-2 income, you're making several $100,000 a year. So losses produced by an oil field that are intangible losses. I mean, it may be producing cash, right? But you actually can deduct the losses against your active income.
Yeah. So to the extent that an oil field produces losses, right? If it's not producing cash flow and you're active in as a GP, you can take those against active income and write those down. So it can be very attractive for the high income earners. Now you are taking some additional liability, right? You have to sign on as a general partner, but that can expose you to some liability. But generally, it's somewhat minimal.
Mm-hmm.
And there are points in time where you can kind of convert to become a limited partner to remove that. And then I think kind of the last big thing I want to kind of wrap it up here and maybe consolidate some thoughts on just what are you seeing right now? What are the best opportunities that you're seeing in the market? And, kind of, no.
2023.
Yeah.
2023. We've had a little bit of we had this big run up in commodity prices in 2022, and we've had a little bit of a dip. And where I think personally, this is me talking now, I think that there are some really good opportunities. I think you're starting to see players that are rationalizing their portfolios, and larger oil and gas operators or companies, and will be looking to divest. And I think, where prices are, because you don't have to pay for the upside, and because there is a fair amount of volatile risk in the pricing, you can buy cash flow streams for a very attractive discounted value.
Yeah.
So that's one of the things that we see that
we're
looking
at. Kind
at.
of a range of returns. Obviously, this is just big picture. A lot of factors go into this, but
Right.
what kind of the range of returns you're buying production at, and then what are you kind of seeing on a production stand or new drilling standpoint?
Right now, just sort of on metrics of what's happening in the A&D markets, most oil and gas production is right now being sold at, taking the cash flow, discounting it at a 15% discount, and then buying it with making that the purchase price and getting.
Did you hear that, guys? I mean, what that means is you can buy an oil field and the cash flows will be around 15% returns
without debt.
Without leverage at all.
Yeah.
No leverage. And add a little bit. If you added, 80% leverage on the real estate, the returns would be insane.
Yeah.
So obviously nobody's doing that. You don't need to do that.
And because you're purchasing at this kind of good value, the upside is not really baked into that. So your upside is kind of just the gravy. And a lot of times you expect a higher rate of return when you're doing new drilling because of the additional risk. So ranges of IRRs there can be 30% plus.
30% to 50%, depending on what the reservoir is.
And you're typically seeing an IRR on a new drill of around 50%, isn't that right?
Of around 50%.
Yeah. So
meaning you drill a new hole, you'll typically see a return in about 50% of that in
2 to 3 years.
Yeah, you'll see a return in 2 years, which is insane. And then it continues to produce for many years after.
Correct.
That.
That's to me the opportunity right now is to buy a cash flow
it's on sale
at a pretty good discount. And then you get the upside, all of the undeveloped locations or undeveloped acreage that come along with it.
So you're not paying for that. You're not paying for the undeveloped locations. You're paying for the producing at a killer return.
And why is that the case? Largely because we don't have the competition right now because private equity
flood the market.
And some of the pensions and endowments who have been traditionally the companies that have come in to make these acquisitions aren't there.
Right.
So there's a lack of capital.
Yeah. It's, and I mean, to the point, what's Buffett been doing?
Well, yeah, he's been buying up a lot of oil stock. He's been very active in betting big. There's just
he's a value investor.
He's a value investor.
Honestly, it's a value play right now.
It is. Yeah. Well, yeah. Thank you all so much for tuning in here, and for those that are still here an hour and 20 minutes later, we commend you for listening to the whole thing. Hopefully, it brought a lot of value, and obviously it's a little bit longer than some of our webinars, but there's a lot to cover and a lot to kind of unpack for folks. And if you are interested in learning more about oil and gas investing, we do have some projects kind of coming down the pike, and so I'd encourage you to join the Investor Club on our website or on our podcast website. So you'll see it at the top there. It'll say Investor Club on the top.
AspenFunds.us.
Yep.
Investor Club.
Yep. And if you're on the podcast website, thebillionairepodcast.com, Investor Club at the top. And be sure to jump in there and get first notification of future deals. And with that, Jeff, thank you so much for coming here in the studio and sharing
your an hour and 20 minutes.
I know.
Very good, man.
Time flies.
Okay.
When you're having fun.
You guys are fun guys to be around.
Awesome. Well, thanks so much. And thanks everyone for tuning in. Appreciate it.
All right. Take care, guys.